Today is a great example of why the FOMC and more specifically Jerome Powell will always be a volatility event and not a directional event. Just as fast as markets went up, they came crashing back down into the close. So let's make some sense of the levels we should be paying attention to into the end of this week. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe. It's now May and we've missed 100K, but we'll still aim for that noble goal anyways. And stick around until the end of today's show. We've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off with a closer look at the SPY daily time frame chart. What do we see here in terms of the overall trend? Remember that we were trying to navigate the short-term trend reversal with lows, higher lows, and into the end of last week, the Friday session technically brought us a higher high. On Monday, we printed another higher high, and this technically can be considered a higher low, but I'm not convinced that we're in a firm daily uptrend. This, of course, is concerning. And the main reason behind all of it is the daily bar structure that printed out today, paired with the breakdown from Tuesday, which we'll see was strong based on the internals in just a moment, and the close from today's session, most importantly, underneath no man's land here at 502. You'll also notice that on Monday, the upper wick of the bar rejects the daily 50 SMA, and keeping us underneath is technically a more bearish than bullish indication. If we're thinking about the weekly line in the sand, you'll also just note that, of course, we are firmly underneath, and the lower high was set underneath 512.50. So the daily chart seems to be in control of the bears. Based on this, I could certainly go out on a limb and call that a bear flag. If we take it on down to the hourly time frame chart, what do we see over here? First and foremost, I want to point out once again the close underneath 502, but more importantly than that, if we really zoom in here, the opening range consolidation was also underneath 502. It's the Jerome Powell volatility that gets us above and then promptly right back down underneath. You'll also notice here on the hourly time frame chart that there really wasn't much of an attempt for any sort of gap fill reversal indication on the Tuesday drawdown, right? As this breakdown is taking place, there are no buyers on the hourly time frame chart that show up to even attempt a gap fill reversal off of 504.25. So for that reason, obviously the bears do have the upper hand here as well on the hourly chart if we're thinking about market structure. One of the interesting components though that I would want to point out to you is just that we didn't make a new lower low, at least intraday, into the close on that FOMC reversal. So that does strike me as interesting. However, it's not really enough to combat the idea that this on the hourly time frame chart is certainly setting up as a head and shoulders, and any breakdowns to repair this poor low, which we'll check out on the market profile in just a second, certainly open the door for the equal low on the daily or weekly time frame chart here down at 494.25. So certainly paying attention to that into the end of this week. I also want to show you very, very briefly on the 5-minute time frame chart here. As the FOMC and press conference from Powell was taking place, you'll notice that there was an attempt to get some bullish consolidation near the highs of the overall move. Namely, on the 5-minute chart, this 5-minute hammer struck me as being very interesting because it took out some of the consolidation lows and yet closed above. Now, obviously, we can see into the end of day, it was all given back, but look at this interesting and very nuanced lower high as well on the very minor counter trend move underneath 504.25. So that also strikes me as a bearish takeaway. If we just go back on up to the hourly time frame chart, we would understand that there really was very little price acceptance, at all during today's session over this kind of key zone at 505.75. If the buyers were going to maintain some sort of strength into the close, you would have ideally seen some sort of consolidation into the close, setting up a bull flag for tomorrow, or just a higher low pullback that would have supported over 504.25. Obviously, that's not the case with the very weak close into the end of today's session. If we bring out a couple of Fibonacci perspectives, I do want to share with you coming in from the low up to the high of the counter trend move. We've closed right on the 61.8, and in my view, the fact that this is confluence with the head and shoulders neckline just means if we break it, again, whenever we're underneath the 61.8, the odds would dramatically increase for a move into the 100% retracement, which once again, that target is at 494.25. You'll also see how if the buyers were going to do something more substantial, that higher low pullback into the close wanted to stay over that 504.25, and it simply did not. We just saw it act as a lower high on the 5-minute time frame chart. If we zoom out a little bit further and take it from the top of the beginning really of the major breakdown, you'll also notice the close underneath the 38.2. That's obviously not bullish. You'll notice that there was a failure, a rejection at the high of day at the 61.8. That is also another bearish indication. So just across the board here, as I'm looking at the charts, sure, there was a reasonable counter trend move off of the lower edge of this week's expected move, but it doesn't strike me as being anything more than that. The Tuesday breakdown was severe, and there was a sharp change in tone. We'll see that on the internals in just a second, but before we go there, let me also show you the intraday anchored view apps just to sort of illustrate that we're underneath all of them, right? So everything acted as a possible breakdown into the close. And remember, we always look at the failure of the buyers as a supporting data point for the bears, right? If the buyers were going to do something more impressive, once again, you would have liked to see a higher low pullback into the afternoon close over these anchored view apps. It simply did not take place, so that once again is a bearish data point. Let's go on over to the market internals now for our S&P. So this is the NYSE, the New York Stock Exchange. Check out the video tutorial in the top right-hand corner if you're not familiar with this dashboard. The main thing we want to focus on is really just the amount of respect we should have for Tuesday's breakdown. I mean, obviously, it was a very clean intraday trend. There were some very clean lower highs that were set and a nice spike into the close, but notice that the internals totally supported the breakdown. Bearish internals, solid volume outflows on the individual session. If you look at the advanced decline line, it's in trend lower zone as of the close, and the index score throughout the bulk of the day was firmly underneath -10, -15. Remember, there's only 25 data points there into the close. If you look at this box right here, that's the read when I hover my cursor into the close. All 25 data points were firing on a bearish indication, right? So Tuesday deserves some respect as absolutely having stronger sellers getting involved in the market there. If we look at the cumulative tick, it also sort of supports that idea, getting underneath -5,000. On today's session, as the FOMC volatility was playing out, notice that we didn't breach positive volume inflows, or at least substantial volume inflows over 300 million. We got near trend higher zone, but faded off quite rapidly. And notice that the tick, it was positive. We'll give some credit where credit was due. Earlier on in the session, it was also positive, but it's just nowhere close to that substantial mark, which, as we know, is 5,000 net positive or negative. Here we go with the market profile. If you're not familiar with this screen, once again, check out the video tutorial in the top right-hand corner. Let's keep it simple on this screen. We're just going to talk about value area and point of control. Here it is on Monday. Here it is on Tuesday, and here it is on today's session. Obviously, bears are making progress with value area and point of control continuously migrating in the downward direction. If we take a slightly more nuanced approach to the market profile, one of the things to point out is that the single prints acted as the top of today's range, right? So the closure of D period single prints right here is the high of day. The market promptly backed off from that. What would that be an indication of? Short-term momentum buyers were the ones who were kind of in control as this advance was taking place. This wasn't really, I wouldn't call it algorithmic buying. I wouldn't call it positional buying. I wouldn't call it anything of the sorts. Those types of buyers do not act this way. They wouldn't really care about the closure of singles. Now, could it be arbitrary? You could always make that argument, but in my view, this is indicative of short-term momentum buyers being the ones pushing the market around, and obviously nobody was interested into the close. We closed really weak. The point of control is dead on the lows of the session anyhow, and you'll also notice that we have an incredibly poor low. So this also brings up another component here, which is just that into the end of this week, I would really pay attention to the repair of this low. Then there's a sneaky little naked point of control back over here. So if you really subscribe to market profile theory, you would sort of understand that breaking and repairing this low, finding buyers at this point of control retest somewhere around, what's the level? I'll give you the exact number here, 50.38 in the ES futures. If we find support and buyers down here, we've repaired the low, we have decent excess. If we could get a move, and here's the kicker, you've got to get back up and over this area right here, 50.65. If you sweep this low, the low of today's session, poor low, repair it structurally, tag up to the point of control, which is naked, it hasn't been tested yet, and then you can make a move up and over 50.65. In my view, that's repairing the structure at the lows and prepping the market for a move in the upward direction. One of the things that's sort of counterintuitive, I suppose, to the read about value area being lower, this is progress for the bears, it absolutely is, but if we see a sweep of the lows and then there's a move back up and over this location right here, 50.65, low of the Tuesday session, and we'll also see it as the sort of overnight low on the futures in just a second. If we can get something that does this, overnight high, my apologies. If we can get something that does that, then all of a sudden, any shorts from down here are likely to squeeze, and then also anybody who is initiating a long actually has really solid trade location. So the repair of the naked point of control and the poor low is a very interesting concept here if you're trying to sort of stretch and look for bullish data points. Don't get me wrong, as of right now, most of the things that we're seeing so far definitely align more so with the bears being in control. Let's take a quick look over at the QQQ and seeing what's going on with the NASDAQ 100. We'll bring up the daily time frame chart. Apologies for the chart flips over here. And on the daily chart, I mean, I think it's very straightforward what's unfolding. I mean, clearly you have this overhead supply, beautiful lower high. It's also a rejection keeping us underneath a now downward sloping 50 SMA. So the bears do like that, of course. You'll also notice that there is no gap fill reversal from the Tuesday session. We closed dead on the lows, even underneath that 425.25. Today's daily bar is a nasty inverted hammer, obviously rejecting the entirety of the Tuesday range and closing weak on the lows. Remember that the no man's land out of the NASDAQ was really somewhere in here. We did not want to see any acceptance below that 425.25 if the buyers were going to maintain some sort of edge, and clearly based on today's close, we have a breakdown there. Let's take it on down to the hourly time frame chart out of the QQQ, see what else we can learn. It's a lot of the same here. There's going to be a lot of overlap between the big indexes. So anyways, the hourly trend is starting to drift back in the downward direction. You have highs, lower highs being offered here, trapping Monday basically as overhead supply. It's a beautiful rejection from a technical perspective in terms of levels off of 430.50. So just like the S&P, you're getting the acknowledgement of a head and shoulders breakdown underneath the low of today's session, and it opens the door into the equal low, which is down here at 415. This number, by the way, it's kind of hidden underneath the weekly expected move, is 421. If we're thinking about the anchored VWAPs, it's a lot of the same over here. We'll bring these out on the intraday. You're underneath all of them. This is a poor low. We'll see on the market profile in just a second. And we can even bring out, so we understand we're underneath the cluster, right? That's pretty straightforward. That's a bearish data point. You could look for continued lower highs anywhere on rejections of the low of the cluster. Staying underneath this 425.25 is just another hourly lower high, looking for the equal low breakdown. And then you get to 415, right? If the buyers are really going to make a stand, and we didn't talk about buyers making a stand over on the S&P, so let's do that now. Just as a quick, obvious little rehash, right? We talked about the recapture of the Tuesday low, right? So on the futures in the market profile, I was talking about a sweep here, tag the point of control, then a higher low like this over 502 starts to get me interested, but you've really got to get more confidence from the buyers on a higher low over 505.75. So my apologies for jumping around a little bit, but that would be where the buyers finally start to gain a little bit more of an edge. The risk reward is obviously better if you're taking a stab at the structure repair and the point of control tag up down here for risk reward that does something like this in the first place. If you're executing up here, you're basically looking at this, maybe to get the full retest of the weekly line in the sand, which once again is 512.50. Anyways, back on over to the QQQ now that we've sort of finished the job over on the S&Ps. Let's bring away those anchored VWAPs. Let's go back to just the daily 50 and 200. There we go. And we'll take out the Fibonacci's just because, again, it's worth being very thorough in the investigation. Obviously, you're underneath the 38.2, meaning that the odds would increase for a 100% retracement. You could basically invert this, right? You'll also notice that the Monday session was consolidation over the 61.8. So in theory, if we could have held that and broke over the weekly line in the sand, the bottom end of the daily overhead supply, I would have been a little bit more constructive in the upward direction looking for that test up here. It obviously just didn't take place. So speaking of things that didn't take place, we can also take the QQQs down to a 5-minute time frame chart. And once again, you can see intraday, the attempt to hold above with that 5-minute hammer here, trying to support above 427.25, but what happens into the close, it's the same concept as the S&P with the intraday lower high beneath 425.25. So the bears definitely have the upper hand over here in the NASDAQ as well as the S&Ps. We took a look from the top down. Let's take a look from the bottom up in terms of Fibonacci's. And once again, just like your S&P, the neckline of the head and shoulders is also your 61.8. So breaking underneath that, of course, increases the odds of a retracement into the lows of last week and just generally this area of support at 415 that we've been discussing so far. What about the market internals for the NASDAQ side of the market? Let's take a quick peek over here. A lot of the same. Let's not rehash all the same points, but respect Tuesday's breakdown based on the intensity of the market internals. And even on today's rally, things were not all that substantial in the upward direction. Notably, the cumulative tick is completely flat into the close, right? What about the market profile for the NASDAQ side of the market? Let's take a look at the NQ futures, and we'll see what's going on over here. Similar concepts. You'll notice we have value area and point of control, value area and point of control, value area and point of control. It's not 3 POs TPOs, excuse me, directly across the bottom, but we still have a lack of material excess. So once again, that does strike me as something that needs repair structurally. Another interesting nuance over here in the NASDAQ futures is that we didn't actually close the D period single prints, whereas the S&P did. So what is this an indication of? In theory, there's very little volume commitment at price. If the buyers were, quote, going to do their job, you would have expected the single prints to close. It didn't, so who has the upper hand? Once again, it seems as though the evidence is pointing towards the sellers having the upper hand here. If there is going to be a counter trend move, your level in the NQ futures is over 17,550. Becomes interesting for that same concept in the S&Ps. Repair, so again, sweep the lows and then a higher low here. Repair this, put in some excess, get the higher low over this, and I do believe that these are either well-positioned longs or shorts that have some sort of propensity to squeeze on a higher low up and over. Once again, that's 17,550 on your NQ futures. If we jump back on over to the QQQs, we described this level right on over here as 425.25, right? A recapture of that with a higher low. You could squeeze again in the upward direction. I'd still be thinking about the opportunity for rejections at 430.50. All of the data still suggests that, maybe a minor squeeze, not really looking for a massive constructive move yet in the upward direction. If you're really going to back this thing off, and we'll just go back out to the daily time frame chart here, that's fine, and take a look at this. I mean, if you really want to be constructive on the market walking forward, if you're tired of the bearish volatility that's taking place here, I mean, that's really what you're hoping for. On the weekly time frame chart, daily time frame chart, you want this to turn into some sort of more firm double bottom with a higher low over this 433.75, recapturing the overhead supply lows. That gets us more confident back to the upside. As long as this lower high is in place, I don't really think that the buyers want to be overly aggressive at this point in the market. We could start searching for a monthly higher low if the breakdown continues and we do ultimately make some sort of weekly lower low. We're just not there yet. It could happen, though, into the end of the week. So keep your eyes peeled for the Saturday update video when we'll discuss that. Here we go, over to the IWM Russell 2000 and the small caps on the daily time frame chart. What do we see if we zoom in here in terms of trend? Just like everything else, downtrend highs, lower highs, lower highs, lower highs on the weekly time frame chart. Speaking of, let's take a look at that weekly time frame chart, because this is getting fairly dangerous over here on the higher time frames. This is one of the concepts we've been describing for a number of weeks now. Previous resistance, 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 resistance even over here acted as resistance for the daily double bottom neckline, daily double top neckline. We are rejecting it currently. So again, what is the issue with that? If you reject that, it's a failure back down into the range below. It's a right shoulder for a weekly head and shoulder. So the main threat out of small caps just remains this 200 to roughly 199 zone acting as a weekly lower high. You can probably hear it in my voice. I've focused on it for a number of videos in a row now. I've got some concerns surrounding that level there. So that is clearly being shown here on the daily time frame chart. Look at the upper wick from today's session engulfing. This is the only bar that took out the Tuesday high. It could not close over that Tuesday high. It couldn't even close over the Tuesday open, so it's not like we have a tremendous amount of strength. And you can also see we've closed underneath this point right here at 196.50. In my view, that's kind of your key area to watch. If you're over, maybe it remains constructive for something that's doing this and trying to build that upward channel. Maybe this is like a stronger bullish edge for anticipating something that looks like this. But again, the confidence only comes from a higher low over that zone. When and if that takes place, we'll have a little bit more of a tailwind over in the S&Ps, but as of right now, it's just continuously looking like a harsh rejection of that area. If we take it on down to the hourly time frame chart here, I think we're backwards on our time frame, so let's bring this to the hourly. There we go. You can see a lot of the same. So hate to sound like a broken record, but here is your possible head and shoulders. The neckline's not so well defined. It would technically be a trend line that looks something like this. Break that. You're looking for the equal lows down here. I think that the most important takeaway is just understanding that we don't want to fall back down into this chop zone over here. And based on today's close, it's kind of looking like we have. In the after hours, we're slightly higher, 197.21 by 26. So, if we're up here, then fine. Once again, like we said on the daily time frame chart, we'll give the buyers the benefit of the doubt, but this gets me way, way more confident. As of right now, the buyers have struggled, and the buyers have struggled here on today's FOMC move in the upward direction. If we come in with the fibs from the low of the move up to the high, just to be congruent with everything, it's sort of your 38.2 zone. Ideally, once again, this strikes me as bullish consolidation, but you've got to be patient for that higher low. I think we've been very, very clear about our feelings here around this $200 and $199 zone. Let's just finish up the candle charts at least with the intraday anchored VWAPs, and we're sort of in the cluster. Once again, a breakdown and then lower high underneath, spending consolidation under that 196.50. I think that's just your recipe for more bearish pressure being entered into the market, and certainly more of a headwind for the S&P compared to a tailwind. What about the market internals for the Russell side of things? Let's take a brief look over at the RUT. And one of the takeaways over here actually is that today was more bullish than what we saw in the other indexes. Now, we know small caps are always very sensitive to economic data. We, of course, had the FOMC today, which we'll break down in just a moment. But for the most part, this actually breached its substantial read up around 125 million. You'll notice we touched trend higher zone. So did the NQ. So we'll give a little bit of leeway there. But notice that this IWM cumulative tick here is much stronger today than what we saw on the Monday session compared to what we saw on the S&Ps and the NASDAQ. That's actually inverted. So it does strike me as a more substantial breakdown. The fact that these more bullish internals did not hold any sort of merit or strength into today's sort of afternoon session, right? So that is a solid takeaway there. Once again, leaning a little bit more bearish out of small caps. If we take a look at the market profile to finish up what's going on with the Russell, what do we see over here? Once again, it becomes very obvious when you're looking at it through this lens. There's your higher high over Tuesday's high. Point of control is slightly higher than what we had out of Tuesday. Tuesday is the only one of the big three indexes where the point of control flipped into the spike from the M period lows. We do still have a poor low on today's session, so the same concepts really apply, but your sort of recapture point, I would argue, is if you take out the lows of today's session to repair this poor low in DNF period, that's fine, but instead of just recapturing the low of the Thursday session, I would want to see a recapture of the point of control to ensure that there's an opportunity for value to possibly progress in the upward direction. If we're comparing value from the Tuesday session to today's Wednesday session, it's completely engulfing. That to me really boils back down to slightly more choppy and indecisive out of the Russell futures, which I think sums up the market as a whole. Remember the title of the weekend update. It's prepare for a volatile week, and what a volatile week it has been. Let's take a brief glance through some supporting evidence. If we take a look firstly at the weekly performance of the S&P sectors, notice what's outperforming its utilities and healthcare, both of which are D for defensive sectors. At the bottom of the barrel, it's the SMH semiconductors down 4.43%. Kind of interesting when just last week in the Saturday update, didn't we talk about them being up over 8%? The week prior to that, they were down over 10%. So a lot of volatility over in semiconductors, but nonetheless, they are lagging on the week, which does add up with a weaker market over here. It's followed by the energy sector, which we have some concerns about that. Global demand for energy seems to be waning as we head into the summer months. Some folks are talking about stagflation here. We'll give you some thoughts on that in just a moment. The tech sector is also down over 3%, 3.29% on the week thus far. Not looking great in the heavier weight risk-on sectors. If we check out the actual structural charts, the utilities continue to maintain an uptrend here. They actually closed for a higher high. So once again, if we're thinking about a risk-off rotation, this is totally indicative of that. Here's the XLV. Although it's outperforming on the week, what is it doing? It's still just technically putting in a bear flag here. Notice the upper wick rejects this breakout point right here, the week close. Slightly concerning. Any further consolidation is just bearish pressure or the lack of bullish pressure for the S&Ps. Also remember, this is D for defensive, even though it's the third heaviest weight sector by market cap. SMH, semiconductors, this is where we've got to talk, right? What did we say in the weekend update? Still the threat of 219.70, certainly breaking down on today's session, and we've lost that key level at 212. So as of right now, this does strike me as a threat to the S&Ps for continued bearish pressure. We obviously saw what AMD did on earnings, not looking so good out of semis. We'll see if Qualcomm can save the day here. Energy sector, this is where we're breaking down. We did make a new swing low, which I think is very interesting, noting the strength from the Friday session of last week. Little, doji there, dragonfly doji, whatever, but it was holding on to this area. And we also know that this was a monthly breakout. So if this is going to turn into a big failed monthly breakout, meaning if there's any indications of another lower high underneath 94.25, strikes me as a little bit of a red flag. Again, if we're thinking about the economy slowing down, inflation persisting, and not to say that crude is the direct correlation to obviously output from the economy, but we also know that the GDP print just sort of missed for the last quarter. So starting to think about this as a general idea, but from a technical standpoint, you would really just watch for the rejection of 94.25. And here it is actually on the monthly time frame chart as well, just to illustrate how big of a failure that is. I mean, you've got months and months of consolidation, years of consolidation, even you could call that. And to fail that breakout and promptly come back down, if there's a lower high and a rotation to the bottom end of the range, that is fairly concerning here. Let's take a look back at some daily charts. We'll jump around a bit. XLK, of course, is important. Lower highs where it matters underneath the breakdown point. XLY, similar concept over here. There was a stronger test of the neckline. You can actually see on Monday with that gap up, we were above with a lower wick. No match for the Tuesday sell-off and today's upper wick, getting us firmly back down underneath 177.75. Bearish takeaway there. XLC, I would say it's kind of neutral if it can hang out inside of this prior range. Anything that's firmly underneath 78.30 obviously is bearish pressure, so the chart doesn't look great with that upper wick. We'll take it in stride. To be bullish again on the XLC, I would need to see some sort of recapture up and over 81.20. We're not there yet. Industrials are doing fine. Real estate's lightweight. Let's move to the XLF financials. Lower highs where it matters, right? That's the theme of the S&P sectors. Lower highs where it matters. XLF financials, second heaviest weighted sector by market cap, rejecting the neckline of the prior, head and shoulders back here. Nasty, technically it's not really a bearish engulfer because we didn't open above and close below, but the upper wick broke the previous day's high and we've closed right at the previous day's low. So basically the same takeaways as a bearish engulfer in the first place, maybe even more powerful because the move was totally unwound instead of just a straight down move, right? So pretty interesting stuff out of the XLF. Once again, it does strike me as a threat for the S&Ps. XLB is lightweight, and we'll finish up the sectors in terms of individual structure with the XLP just because it is D for defensive. I like the fact that it's holding up, in terms of the chart structure. I don't like what it implies for the broad market as a whole, but it's D for defensive, and it's holding up over an upward sloping 50 SMA. We've talked about how it can produce some sort of pie in the sky inverted head and shoulders. Any continued holds and price acceptance over 75, yeah, it looks great from a chart perspective, but a breakout there, again, it just continues to support more of the idea of a risk-off rotation. You can also see the risk-off rotation over here in the sector ratios. If you're not familiar with the screen, check out the video tutorial in the top right-hand corner. This, of course, is a bearish indication. This is kind of neutral. Financials are holding in there, but remember the structural chart is offering a lower high where it matters. XLY looks more like a lower high in a downtrend, right? The XLV trying to come off of this higher low, slightly more D for defensive over here. This is risk off. This, of course, is risk off as well. If we look at a couple of specialized ratios, we don't have to hit them all today, but look at the lower high underneath. Again, risk off rotation is alive and in place. This one does strike me as being a little bit more interesting to look at. This is the SMH semiconductors versus the XLV healthcare sector. So risk on versus risk off still, but subtle opportunity here for maybe a higher low if it reverses like instantly tomorrow. It's, again, small back pocket data point for the buyers. If this could be paired with, so if this acts as a higher low and we trade back up into an equal high, if you can pair that with the sweep of the poor low on the market profile and a recapture of that Tuesday low of day, that might be the winning combination if you're looking for a long trade into the end of this week. So pay attention to that one. Let's move along to the dollar over here. Dollar continues to consolidate basically in a bull flag, which is no surprise considering what's going on over here in interest rates, right? You can see that we're just still high and tight even after the Fed. No surprise considering that the Fed is continuing to sort of echo the sentiments of higher for longer. Here is your inverted ZT, pretty much unchanged inside of this overall balance. So what we should do is take a brief glance over at the Fed tracker tool. Really no big news to report over here, even for the June timeframe meeting. We're about 91% odds of a continued pause here at 525 to 550. Jerome Powell today was very, very dovish, in my opinion. A couple of things. If we take a look at the actual statement, this is the strikeout version where they highlight what changed, what was removed, what was added. And notice here that the Fed, notably Jerome Powell, they're deciding to slow the pace of the decline in its securities holdings, meaning that, if they're tightening, quantitative tightening looks something like this, they're going to slow that pace a little bit. It's still going to be going down, but not nearly as aggressively, right? And so technically, you would think that that has more of a dovish tone to it. Now, of course it does. And Jerome Powell also, really followed that up during his press conference speech today by mentioning a number of times that, we're very confident inflation's going to get back to 2%, which I totally understand. He's got a role to play. And of course, he can't make the public believe that inflation is going to come roaring back. But the inflation reads have not been good. We know that we've been stagnating at roughly 3%. So he's got some work to do. Some of the comments as well from Jerome Powell, just if we're thinking about what took place, Labor market, incredibly robust. He's willing to respond to the labor market if things start to falter over there. They're willing to cut rates if things really get out of hand from the unemployment rate, which as of right now, we're really not forecasting by any stretch of the imagination. If you take a look at the Thursday claims, we're just going to open up this chart here. They've been really stable and low, not even close to these highs at 225,000. Never mind reads up and over 250,000. So not expecting anything crazy if we're just looking forward here on Friday with the unemployment rate. Now, one of the things that will be fairly influential is going to be the NFP employment change. How many jobs are actually being added to the economy? If we look back at what's taking place here, the ADP actually beat the number, but it was still substantially, or I shouldn't maybe say substantially, but it was underneath the prior, right? So it is contracting a little bit. If you're looking for continued evidence of contracting in the job market, it's getting tighter out there. You could look no further than JOLTS as well. JOLTS came in this morning at an 8.49 million versus 8.68 million. So again, job openings are sort of slowing down. Another thing that's so that's a tailwind for Powell. Labor market's still doing okay, right? But if you take a look at this, the employment cost index is the ECI on a quarter-over-quarter basis, 1.2. That's a little hot. So if we're thinking about a wage price spiral, another risk to pay attention to into the end of this week is going to be your hourly earnings, the average for your month over month. So paying attention to that stuff out of the sort of calendar into the end of the week. If we look at some more interesting data here, this is the JOLTS breakdown by sector, and you'll notice that the largest breakdown is actually way down here in red. There's a pretty sharp drop off. I don't want to call it about half, maybe 2/3, but that segment is actually construction. And construction, as we know, is very cyclical for the economy, and it has a lot to do with interest rates. So as construction backs off here, what do you think that means about the housing market? Obviously, as an impact from interest rates, it's slowing down. So don't expect the cyclical side of the economy to be roaring back if we're already seeing a tightening out of construction jobs. Another interesting take here is the ISM Manufacturing Index. We know that goods inflation has roared back and is sort of contributing to the resurgence of inflation or the stability at 3%. We know that services inflation, we know that was going to be the sticky side anyways, but this rebound happening here, again, what happens if manufacturing goes positive? Will we see goods inflation accelerate? I mean, it's very possible. If we're thinking about the trend here, getting a sequence of higher lows, everything was down other than production. So if you're producing stuff, you've obviously got to start selling stuff. Otherwise, that sort of spells a different issue for the economy. So paying attention to that, this small uptrend that's building out from negative, if we flip positive, again, expect more pressures for inflation, but specifically out of the goods side here based on ISM manufacturing. We already talked about what's on tap for the end of the week. Obviously, we know we're dealing with the NFP and the full labor report, and then into the end of the week in terms of earnings. Today, after the close, we got Qualcomm. We'll take a look at that chart in just a moment. And then Apple is your heavy hitter on Thursday after the bell rings. Certainly going to be influential for your market. So if you think you're out of the woods from a volatility perspective, think twice. We're not all the way there yet. Let's take a look at a couple of other supporting evidence indications. Just bonds in relationship to themselves remain stable, once again indicating shorter duration risk preference. Longer dated preference, of course, would be equities, so that's a headwind for markets. Credit spreads are fairly stable down here. I did want to point that out considering the risks we were talking about as they were elevating. So this is alleviating some pressure out of the market. However, HYG in isolation just offering a mirrored pattern to the S&Ps on today's rally, a lower high underneath 76.60, which as we know is sort of a big deal here. So continuing to expect bearish pressure from the high yield junk bond side of things. If we look at Bitcoin as well, so not that this is overly influential to the market, but I do find it interesting that it broke down underneath the bottom end of the flag here as a risk off indication. Remember that this is totally a speculative asset as of right now. It's kind of aligning with the take we have so far based on the S&P sectors and some of the headwinds we've described. Let's move into breadth, market breadth. We want to drop this down to a daily time frame chart. Liking how it's staying positive, but still near the zero mark. It's got to really accelerate back to doing something like this. That would be more constructive for the market as a whole. So if you're looking for bullish data points, look for this to stay over zero. Not totally sold on that idea yet. I still think that we can waver around zero, and it's not going to be so clear like what we had over here. Let's jump on over to the SPX A50R. This is more bearish takeaway, lower high underneath the 50% mark. RSP. One of the things that I would encourage you to pay attention to into the end of this week is if it makes a lower low, but weighted equities do not. If this makes a lower low, that is concerning, especially if weighted is not following along nicely. That would be a big watch into the end of this week. What about volatility? Beautiful place for it to find some support, huh? What did we say in the Saturday update? Previous resistance, resistance, resistance. Acted as support. Wouldn't that be something if it bounced off of this same level? That's exactly what the lower wick is suggesting from today's session. So if you've made it to this point in tonight's episode, do me a favor and hit the thumbs up button, but most importantly, subscribe for not 100K by May, but maybe we'll push it off to maybe the end of the summer, the end of the year. See if we can hit those 100,000 subscribers. Apple's up first on the chopping block, clearly a lower high being offered on the daily time frame chart. This is also worth noting. We've been making this comparison in the pre-market prep, but the gap up on Monday was unable to clear these pivot highs, whereas if we take a look at Tesla, for example, I get it's lower today, but we did gap up over these pivot highs, which is noteworthy. So again, just as a compare and contrast, Apple was not as strong on the gap up from Monday's session. So if we understand that, the idea should be that a lower high can now produce an equal low, if not a lower low. What's the issue with this chart? Of course, is just that earnings are on Thursday after the close, so take all of that analysis with a grain of salt. I do think today's rejection of the 50 SMA, if we take a look at the hourly time frame chart, the rejection of these prior lows from the balance before the breakdown spike into the close on the Tuesday session, it seems like the proper sequence for bears to be gaining control and looking for that continuation in the downward direction. Once again, please be mindful of earnings. I am probably not going to be trading this on tomorrow's session. Let's move along to Microsoft. What's going on with Softy? This one's in the clear, and we can at least look for some more relevant patterns here. We got to start on the daily time frame chart because 400 is a key inflection point that we need to understand. If this is all overhead supply, look at the upper wick rejection from today's session. We did the dance. Here's the Meta gap down. Here's the Microsoft earnings gap up, maybe some sympathy to Google gap up as well. It's been 3 days straight down and a rejection now in the upper wick of today's session of 400, aka the bottom end of what is now certainly considered overhead supply. So equal low breakdowns under 390, looking to target this. You've got a thin structure retracement in here. Your next lower target would be at 376.25. So not looking great out of Microsoft here on the hourly time frame chart. You can see quite clearly if we snap this level and lower high, at least equal lows, again, that's 390, then a breakdown from there brings you into those levels we just described, 384.25 and beyond. If you're really looking for a stronger move as a scalp to the upside, I would be neutral through here. I think that this is kind of like probably a bearish edge, obviously underneath that 400 based on the daily analysis we just conducted, but maybe something that does this and consolidates, I think you've got an opportunity for a short-term long opportunity to squeeze through this thin structure up and over these consolidation highs. That level is very dim, but the number is 402.35. So maintaining more of a bearish edge here out of Microsoft, but willing to take this as a very quick scalp if it wants to play into the end of this week or perhaps even early next week. Let's move along to Google, just continuing to close the earnings gap. I think the watch here is very simple. Today we printed an inside bar, meaning that if we take out the lows, inside bar breaks down, and ultimately you're looking for a retest of 159.50. Previous resistance, and a majority of the gap close now has the opportunity to act as support. So if you're looking for a long out of Google, it requires a little bit of patience. Let the breakdown take place and then see if we can spot buyers showing up on something like a 5 or 15 minute time frame chart to initiate a trade somewhere around 159.50. The idea would be that you're looking for a higher low on the daily chart, right? Lows, higher lows, higher lows, higher lows. Next higher low is found somewhere in here on the retest of this level. Your risk looks something like this box, and your reward, ultimately the range that you would try to travel, is back up to an equal high if the uptrend is going to maintain itself, even if you just went to the bottom end of the earnings gap up range for a retest there and some lower high was produced. That's still very clearly a 3-to-1 risk reward ratio, looking at something of that sorts to respect market structure. Here it is on the hourly time frame side of things. I think that the rejection into the close, just like everything else that we've covered so far, basically speaks for itself. There is no price acceptance over this key inflection point here, which is the open of the Tuesday session anyhow, just as an FYI. You can see we rejected it in the morning session, tried to break into the afternoon, no love into the close. So what does that mean? Failed breakout, failed counter trend move from the buyers. And in theory, that would mean that it should be easier to move into that 159.50 level down below. Let's move along. Amazon is up next. Earnings are in the rearview mirror now, Tuesday after the close. What a load of volatility. Be my guest if you want to play around inside of this nonsense, but I'm basically willing to say, Amazon, you're going on the back burner until something more obvious sets up. I'm not seeing it here on the hourly time frame chart. If we take a look at the daily time frame chart, it's the same thing. Massive day down, a little bit up, a little bit down, gap sort of unchanged. It's just all over the place. The structure is not clear. You could make the argument, maybe on the weekly even, that something like this is maybe emerging. I'm just not interested in Amazon in this box. It's a day up, it's a day down. Scalp it if you'd like, but it's not the cleanest mover. NVIDIA is up next. What do we see out of NVDA? Got to give credit where credit is due. I was thinking about the pullback long into 481.50 today, thinking that, okay, if this is going to hold as a double bottom, if we're recapturing the bottom end of the range, fantastic. Of course, AMD sympathy move, AMD was down, right, on earnings, maybe should have been considered a little bit more strongly on my part. I'll take ownership on that one. But there was nothing there. Like even before the FOMC, before the Fed, a little bit of like maybe a 5-minute reaction. We'll take a look here real quickly. So on the morning session, quick 5-minute reaction, but promptly turning into a lower high and drifting into a downtrend. So in my view, if we just flip it back to an hourly, it's totally bears continuing the parade in the downward direction. Daily now has highs, lower highs, lower highs. If we can stay underneath 841.50, I think it's just asking for lower, equal lows over time, and we'll take it in stride from there. So your key level into the end of this week is simply that number, 841.50. If we're below, leaning more bearish, looking for 796, lows down here at 772.25. If we get back above it, I would have to strongly reconsider just based on all of the moves that we saw around that inflection point for today's session. So 841.50, do not forget it. Next up, we've got AMDizzle. What's going on here? After earnings, gapping down, leaving most of that gap unfilled, rejecting this area in here. Remember that this is where there was support, recaptured, and then everything was fine and dandy, actually even recapturing this level up here, which going out to the daily represents sort of the neckline, right? So this area. So the fact that we've gapped back down into these lows strikes me as just a huge lower high happening here. So bearish consolidation happens where? Anything underneath 151.10, bears retain control, looking for continued moves in the downward direction. Next major target, daily 200 SMA could be a contender, but the structural level is at 133.25. Moving along to the metaverse, what's going on with Zuckerberg's Fantasyland? Keep it simple, stupid over here. No need to complicate this one. You've got to get a higher low over this level. Higher low over 443.25, and we're willing to trade it through the gap range overhead. You can see the first indications of a failed breakout on today's session. Still keeping it in play as long as it's in this zone here. I wouldn't short it just yet. For shorts, really got to look for a move underneath the open from the earnings gap down bar. We're just not even close as of right now. Let's move along to Tesla. What's going on with Mr. Musk? We saw this on the daily chart to begin when we were talking about the relative strength, Apple and Tesla sort of backlash, if you will, on the gap up from Monday. So we're underneath and inside of the gap being this yellow box over here. So the lower high and the closure back inside would lead me to believe that it wouldn't be unreasonable for a continued move to close that gap. The only issue with this is that this is a pretty major level here. These previous highs at 176.75, I mean, they deserve some respect. They're sort of in between us and the gap close currently, so it's going to make the risk reward a little bit harder to pull off if you're looking for a short out of Tesla. I don't think it's going to be so easy just spotting the lower high and trying to travel through the gap range back down into 170.15. Even if we do something like that, I would encourage you to think about the daily time frame chart and the possibility of a higher low, right? If the higher low isn't offered over the top of the range from back here, that's fine. You can still get a higher low on the gap fill reversal here, right? And as a matter of fact, on the weekly time frame chart, you start to emerge with an inverted head and shoulders, and maybe there's a stronger reversal out of Tesla. As of right now, the daily bears are still in the driver's seat until proven otherwise. The weekly bears are definitely feeling in control here as well. But if that higher low starts to emerge, we will take note. We just don't have the candle structure yet to confidently say that, yes, it's looking likely. Look at the inverted hammer, upper wick, rejecting that sort of retest point in here. Doesn't look pretty yet, but keeping an open mind to it. So once again, your levels, 176.75 and 170.15 for those possible higher lows. If you want to argue weekly inverted head and shoulders, I mean, yeah, technically speaking, you could go all the way down to 161.25, but let's be honest with ourselves, that's not pretty. That is not pretty in terms of the daily chart, just fully retracing the gap up here and the recapture of the entire range as a whole. Being back down here, really an indication of a lack of progress. Netflix, it's just getting annoying at this point, so maybe we'll hold a vote in the comment section to remove it from the core list. It's day down, day up, there's madness all over the place. It is technically a descending triangle as of right now, so if you can break down from that, fine, do your thing. Be my guest if you want to trade it over 554.30. I think with FOMC, with the volatility we've experienced so far this week, the volatility that's going to persist with Apple earnings after the close tomorrow, as well as the labor report on Friday in the morning session, a lot of these charts are kind of stuck in limbo, which is, it happens quarterly, right? We always run into earnings season, we run into volatility, run into the Fed, so it happens, but conditions right now, they're more volatile than, solid in terms of directional movement. So, if you're scalping intraday, this is like your dream. But if you're looking for solid movement from the market, predictable movement from the market, this is not really the context to be operating under that sort of premise with. J&J is the first trade idea I have for you. So Johnson & Johnson, consumer staples, what do we see out of this? If this is going to be a daily double bottom, break that neckline, strong close above, relative strength to the market. Any consolidation over 150.25 is looking good. And let's take a look at the hourly chart to spot a target together. A couple things come to mind. That would be your sort of reach into the end of this week. It's the origin of this breakdown right here. You could also look for, if this breaks, I'm mostly inclined to say that stretch target is what you should be looking for in terms of solid risk reward. So a couple of ways to play this. I'm going to get rid of that level. And for the most part, this consolidation is a bull flag, right? It's over the neckline of that daily double bottom we just saw. This is a trade in the upward direction. If you can spot the pullback long off of this level down here, and you can pull off risk reward, let's just say that markets move lower, right? If that's your risk and this is your reward, that's all day long going to be some sort of scalp that's available, and then you would hold some runners and monitor for continuation. What did we just describe in terms of volatility on Netflix? I don't know that we have the ideal market conditions for a trade like that to play out. So that would be the idea behind the chart setup here. But again, condition-wise, I would manage expectations on that one. So that's Johnson & Johnson. Next up, we've got GS. What's going on with GS, Goldman Sachs? Looks good on an hourly chart, so we'll just stay here for the moment. Look at your clean retest, right? So break, retest, looking for a higher low to be set here at 425. What's the issue, right? Looks really pretty on the hourly chart, absolutely, but here it is on the daily. Notice that we made a higher high on the daily bar, and just like we talked about in the financial sector, it's almost like a bearish engulfer, right? We didn't technically close underneath the previous day's low, but this does strike me as a failed breakout near the highs. So if we were to sweep underneath 425 with an intraday lower high, so now let's go back to the hourly chart with this understanding. If we were to sweep this with a lower high, I think that this is a short trade into the end of this week, setting up risk reward that looks something like this, right? Your target would be 418 on a breakdown of 425 with a stop loosely just above. That's Goldman Sachs. Next up, lastly, we've got LLY. This is a longer term trade idea. It really requires the daily chart, maybe even the weekly chart. What do we know about the XLV? XLV is D for defensive. So are the conditions, is the environment right for possible outperformance from a healthcare component like Eli Lilly? I think the answer is absolutely yes. Notice the inside bar on today's session. We do have this gap that's menacing underneath us, but if we can hold this consolidation and crack these equal highs at 796.25, that's blue sky territories up above. Let's take a look at the weekly time frame chart. It's just going to emerge as a weekly bull flag, right? There you go. As long as we're holding this, looking for those blue sky territories. So a longer term swing idea, but I did want to bring it up in today's episode of the Midweek Market Update. That's going to do it for me. Come on out to the pre-market prep tomorrow morning at 8 o'clock. We're going to start a little bit earlier. Show is really well received this morning at 8 o'clock, so we'll do it again for tomorrow's session. 8 o'clock Eastern time, we will kick off the pre-market prep looking through our ES futures, NQ futures, Russell, SPY, QQQ, IWM, the core list, the whole 9 yards. Be there or be square. I think that's what they say, right? So if you enjoyed today's episode or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Remember to subscribe. We will see you in the next one, and have a green trading week.